Welcome back. You're watching the Mutual Fund Show, and we're speaking about the equal weight strategy of passive investing. We're joined now by Amit Kukreja, the founder of amitkukreja.com, and Tarun Birani, who is the founder and chief executive officer of TBNG Capital Advisors. Thank you so much to the both of you for joining in. Let's spell this out a little further, and we'll talk about the drawbacks as well. But Tarun, anything to add in terms of what you think are the key benefits of investing in an equal weight strategy?
Right. Hi, Alex, and hi, Amit. First of all, Alex, I think you started with the HDFC examples to start with. And I feel in hindsight, we all are heroes, right? I think we just feel that we could have made this, we could have made that. But I would give another example also where one stock has moved 200% in 1 year. And because of market capitalization strategy, the index has benefited largely because of that, right? So I think these things will keep happening in market. So I don't think we should go too much in detail. As rightly mentioned by Amit, that what is the suitability of the client? What is the risk profile of the client? How much risk the client can stomach? These need to be the most important consideration before selecting any fund or any schemes for your portfolio. Talking about equal weight portfolio, according to me, the most important thing it brings to the table is diversification. Unlike a market cap oriented strategy, which is purely focused on market cap, a equal weighted strategy will have larger diversification. So benefit of diversification will be there. Another very large benefit equal weighted strategy gives is rebalancing on a timely basis. So since they have to maintain an equal weighted at all the time, so the rebalancing will be much better compared to any other strategy. So any investor who want allocation to be managed in a systematic manner and rebalanced on a timely basis, I think the equal weighted strategy is a very good strategy. Again, the potential of outperformance and underperformance, like you mentioned one example, that definitely comes with equal weighted strategies. And I think from a simplicity and transparency point of view, it's a great strategy according to me. But at the same time, can I spell out some disadvantages also of this strategy?
Yeah, go ahead, because I was coming to that anyway.
Yeah. So one big disadvantage which I feel is higher cost and a turnover ratio of this strategy compared to any other strategy which we look at on smart beta. So since they have to maintain equal weighted at all the time, so it will involve higher cost because they need to maintain that. Apart from that, volatility, according to me, they will exhibit higher volatility due to inclusion of smaller companies in the portfolio. So apart from the top companies, equal weighted companies will have on the lesser market cap companies also in the portfolio. So it will have larger volatility because of this. Again, due to market efficiency issues can also comes in because of equal weighted thing. And again, because some less efficient companies may also be part of your portfolio. And there could be some liquidity concern also compared to, let's say, a market cap oriented, the top companies will always have better
Right.
liquidity compared to these companies.
Got it. So you've laid out both the advantages as well as the drawbacks. Quick 30-second view on this one, Tarun. Do you want to add to that? So Amit is talking about a 5 to 10% of that large cap orientation or that passive orientation. What do you think?
So I strongly feel, Alex, that there is a core portfolio and a satellite portfolio. And core portfolio is a portfolio which basically is aligned to your larger strategic goals, right? But when you look at tactical portfolio, you may look at strategy which can perform well in a certain market environment. So there are strategies like momentum strategies. There are strategies like low volatility strategies. There are strategies which are like a strategy like this, what we are talking equal weight strategy. So I feel one need to do more research around various market cycles and which strategy has worked well in which market environment. So higher interest rate environment where you are expecting high beta or lower beta kind of things to do well. Right. I think the low volatility index can do better.
Right.
So I would purely take it like a core and satellite mix of the client portfolio. And in the satellite portion, one can actually look at it if the market conditions are right.
tactical allocation. Understood. Thank you so much, Amit, as well as Tarun, for joining in and giving us that perspective. So the crux essentially is that this is a strategy that can potentially beat the benchmark, but you should ideally use this as a tactical allocation or a satellite allocation in your overall portfolio. If you've got questions for us, you should send them to us on any one of our social media platforms, and we will in fact very soon have a WhatsApp number to share with you as well. There's lots lined up over the course of the day. Do stay tuned. This is NDTV Profit.